One question I often get from business owner clients of mine is whether or not they should put their spouse on payroll. In this video, I'm going to walk you through the math behind that decision and help you determine whether or not you should add your spouse on payroll in order to maximize retirement contributions or not. As a disclaimer, the IRS mandates that if your spouse is doing bona fide work for your business, they must be compensated accordingly, either from guaranteed payments, W-2, or 1099, depending on the type of work they do and the way that you're organized. To get to the heart of the issue, it's really a trade-off between additional payroll taxes and the ability to contribute additional dollars to your retirement accounts and get tax privilege growth on those dollars. We're going to assume for today's conversation that all of the other retirement account contributions are already maxed out, and that's why we're looking at whether or not we should put our spouse on payroll or increase their compensation. So if a spouse is on payroll, then you can make retirement account contributions in their name and do so either on a traditional or Roth basis and get tax privileges on those dollars over time. If your spouse is not on payroll, then you'll have to invest those dollars in a non-qualified taxable brokerage account on which you'll pay taxes down the road, either long-term capital gain taxes or ordinary income taxes, depending on what you were invested in and how long you held it. For the sake of today's video, we'll assume that you're paying long-term capital gain taxes. So let's take a look at an example. First, we're going to have to talk about some assumptions. Rate of return, we're going to use 7%. Long-term capital gain tax rate, we're going to assume 15%. Some people are going to be in the 0% bracket, some are going to be in the 20% bracket. We're going to start with 15% and see how two scenarios compare. We're going to do so over a period of 30 years and assume that this person has $30,000 of profit after all other business expenses and compensation. So on the left, we'll show what happens if we're able to invest those dollars in Roth accounts versus if we don't have any more retirement account contribution space and we have to invest those dollars in a taxable account instead. So if we're investing those dollars in Roth, there's going to be an additional FICA cost, that's Social Security and Medicare tax, and we have $25,000 and some change to invest. On the other hand, if we're just investing it in a taxable account, there is no additional payroll tax liability. We're going to invest all $30,000, but it is going to generate some additional taxes over time. So the pre-tax value over 30 years, assuming a 7% rate of return on $30,000, we're going to have $193,000, a good portion of which is gain, and no taxes due because it's Roth investments. We're assuming those are going to be qualified distributions. The after-tax value in that account is $193,000. On the other side, if we're making taxable investments, the pre-tax value of the account after 30 years is $228,000. We started with a larger net amount to invest. The gain on the original investment is going to be taxable as a long-term capital gain. Here's those long-term capital gain taxes due. So our after-tax value is $198,000. So you can see, given these assumptions, it would make more sense to leave spouse off of payroll and just make those contributions into taxable brokerage accounts. Even after paying those capital gain taxes, the after-tax value of the account after a 30-year period looks more favorable. Now, what if we change some of these assumptions? So if we do a low rate of return, maybe 4%, you can see in this scenario, it's still going to be better to have taxable investments as opposed to increasing payroll to a spouse and making additional retirement account contributions. If we go to the other end of the spectrum, and let's say we get a 15% average rate of return over time, which would be fantastic, then you can see that the dollar figures are still pretty similar. It slightly is better to make taxable investments instead. Let's go back to 7%. And we're going to look at, well, what happens instead if we change the long-term capital gains tax rate? And this is really where the differences come into play. So if we assume a 20% long-term capital gain tax rate, that's going to eat into more of those gains. And in that scenario, it actually works out better to have additional Roth investments instead. Now, if we're investing for a shorter period of time, that may not be the case because there's not as many gains that are going to be taxable, in which case it'd be better to have taxable investments. If we have a really, really long investment time horizon, let's say 50 years, then it's going to make more sense to do those Roth investments instead. Most people are going to be in the 15% tax bracket. 7% is a reasonable rate of return to assume. And 20 to 30 years is what most people's investment time horizon is. And so in most situations, it makes sense to make taxable investments and leave your spouse off of payroll. So in what situations would it make sense to put your spouse on payroll? One would be if you run a business with highly variable income from year to year and you're moving between tax brackets each year, there could be a lot of value in having the ability to defer taxes to a lower income year and pay on them at that point in time, either through a distribution or a Roth conversion. In that situation, it may make more sense instead to have that layer of flexibility on the timing of when you're going to pay the taxes on those dollars. And in that situation, I would lean towards doing additional retirement account contributions. Another situation I've run across is when a spouse is close to qualifying for their own Social Security retirement benefit, they just need 1 or 2 or 3 more credits, then it may make sense to put them on payroll in order to get them to a point where they qualify for their own benefit to give you more flexibility on your Social Security claiming strategy down the road. The last scenario is one that we looked at in our example, and that's going to be one where you have a really long investment horizon, a really high long-term capital gain tax rate, or if we're assuming your ordinary income tax rate, and you're assuming a reasonably high rate of return on your investments over time. That combination can lead to an example where it makes more sense to focus on putting more dollars in retirement accounts by adding your spouse on payroll. So what I hope you take away from this is that for most people, the correct answer is don't put your spouse on payroll or don't increase their compensation in order to make more retirement account contributions. There are situations where it can make sense, and these numbers are going to depend on your specific situation. So if you're in the situation where you're trying to determine, should I put my spouse on payroll, feel free to reach out. We run these type of scenarios regularly for our business owner clients to determine what the right answer is for your situation. My goal is to help you retire better. If this has been helpful, subscribe. Let me know what would be more helpful for you as a business owner as you try and plan your finances for the future.